I'm sorry, it's a bit late. The technology didn't work as usual. No, actually, no, it usually does work, but this time it just failed us. So anyway, here we are, and it's great to be with you. Sorry about last week. For those who are interested, Deb is on the mend, but it's a bit up and down. I've just come from home and she's having a rest at the moment, and some other family members are with her. But look, it's great to be with you, and there's tons of questions today, so we better get stuck straight into it. And don't forget, it's general advice only, not personal advice. I can't take into account your own circumstances, and the advice may not be appropriate for you. So please bear that in mind. And if you've got any questions as we're going along, feel free to pop them in and I'll get to them, I hope. But we better get going, because otherwise we'll all be doing nothing else today but talking, which might be okay, but anyway. So first question is from Chris. He says, "Hi Alan, how do LICs, LICs, listed investment companies, calculate their returns? The NAOS January Fund Fact Sheet, that's ASX NAC, shows a NAC investment portfolio performance of 72.76%, yet the share price, which listed in November 2014 at $1, is shown as $1.05. This obviously doesn't include dividends, but it doesn't seem to add up to me. Can you find out how this figure is calculated, and is it a fair representation of the underlying value and performance of the fund? P.S. Very much enjoyed the Sinata interview. I wish you'd ask them if they'll be able to fix knees." I wish I had too, Chris, because I'm a bit of a knee sufferer myself, and I must say I'll now ring them up. You've prompted me to do that. I will ring up Sinata, that guy, I can't remember his name, who I interviewed, and ask him if they're going to fix knees, because that'd be good to know, and then I'll tell you. Anyway, back to NAOS. I actually tried ringing them this morning when I saw your question and failed to get through. So I think the best thing for me to do would be to get Sebastian Evans on the phone and interview him for you and ask him these things. I always get a bit puzzled by this, to be honest, myself. I think part of it is explained by the dividends, that's for sure. Part of it by the fact that the NAC share price is currently at a discount of almost 10% to net asset value. So when they talk about their investment portfolio performance, they're talking about their net asset value. But if the thing goes to a discount, then obviously the performance of the net asset value isn't being built in entirely. Now, whether, I haven't done the calculation, but whether it's entirely accounted for by dividends plus the discount, I'm not sure. I doubt it. I mean, that's a big difference. I did check out the figures that you show there, and you're pretty right. I mean, the return since inception of the NAC fund, according to their fund performance returns, is 70% over that time, and the share price has not done that. That's for sure. So look, best thing I can do, rather than rabbit on about it, the best thing I can do is get Sebastian Evans on the phone, interview him, and we'll let you know when that's happening. So hopefully I'll get him next week. Murray says, looking for a fund with solid returns, 7 to 8, I presume, percent, and reinvestment and a savings plan. Now, Murray, you've given me a few of your personal details. I can't take that into account. Don't want to know, really. But then you say, what about Spaceship Super? Now, Spaceship Super is one of a number of new super funds aimed at millennials. So clearly not aimed at you, Murray. And they're a bit gimmicky, really. And the other thing is they're new. So there's Spaceship and there's Super with a Z. And their difference is that they invest mostly in ETFs, but they've got a fair bit of money going into technology, either technology ETFs or directly into technology stocks. Now, I think it's a bit soon for someone like you to be investing in those things, for anyone really. I mean, look, if you're a millennial, you're looking for something interesting and different, then fine, go into Spaceship Super or Zupa. If you're looking, if someone's looking for a fund, and you're looking for, I mean, we're talking about a large super fund here. We're not talking about a managed fund, I guess. So a super fund, the best performing super fund consistently in Australia has been Host Plus. Their most recent returns are 13%, not 7 or 8. So they're doing very well, and I happen to know the people who run them. They're a very good fund manager, very good super fund. The people who run them are terrific. As to whether they've got all the things you need, I presume they do. They're pretty well covered on everything. They've obviously got insurance. So look, that's my suggestion. I'm not recommending it, but I am saying that the best performing super fund with the best returns has been Host Plus. Now they always say, and it's true, that past performance is not a reliable guide to future performance. But my answer to that is that's all you got, really. I mean, if someone's got a history of good returns, that shows that they're good at their job. And unless the board comes in and sacks everybody and puts in a new team, then you can pretty much rely on that continuing, I reckon. It's all, as I say, it's all you got. And the past performance is an indication of whether they're any good. Peter says, I read Alan's interview with Landau of L1 Capital and see they're launching an LIC. Dumb question, how do I buy into it? Not a dumb question at all, Peter. There's no such thing as a dumb question. And the answer is you could wait until it was listed on the stock exchange, the L1 Capital long-short fund, or you could line up to get in on the float. And it's still open. I did ring them this morning and I got hold of Mark Landau, and Mark's saying that they're about halfway through their roadshow. They've got a lot of response, a lot of enthusiasm for the IPO. He reckons they'll easily make the top end of the range that they're looking for, which is $600 million, which is not surprising because they're a pretty good bunch of fund managers. They've been doing good returns. Fantastic returns, in fact, and as I think you heard if you listened to the interview, guy knows what he's talking about. So I reckon you could do worse than lining up. Mark reckons it's well worth going onto their website and registering your interest in the IPO. So if you do that, perhaps tell them I sent you. If they have a question there, tell them you found out about it through the Constant Investor, and they might give you a better run. But anyway, you've got to be in it to win it. I'd say that they're going to be oversubscribed and they'll probably scale people back from what they want. But nevertheless, I do think it's probably worth getting in on the float because, and the reason, this is an important reason, when they come on, they're likely to go to a premium. So if you can get it at the issue price, that's probably going to end up being a good price, I'd say. It'll be very surprising if they end up going to a discount and you can get them cheaper after they float. So I think it's well worth buying in with this one in the IPO. Unlike, by the way, the NAOS one, which is at a discount now to net assets, and you can get them for 10% less than net assets if you buy them on the market. So there's another question on L1 Capital. Wyatt says, the interview with L1 Capital was interesting, but I'm interested in your view of the 1.4% fee plus the 20% bonus on a fairly easy watermark. WAM, Wilson Asset Management, alternatively, is a straight 1%, I think. L1 had better perform. Well, indeed, that's right. They had better perform, but the thing is you don't pay them if they don't perform, and really you've got to look at their fees, their returns after fees. And that's the thing. I mean, if you go onto the L1 Capital website, you'll find all of their performance there after fees. And that's really what matters to you. And I used to be against performance fees because they seem to be so steep, such huge percentages. But then after a while, I was persuaded by Carl Siegling, really, of Cadence Capital, that people pay executives, company executives for performance. Why not fund managers? I think that it's a good it's a good principle. I think the 1.4% base fee is probably too high. I'd like to see a base fee of 1%. I think that you know, I think a base fee is okay. You know, they've got to keep the business going. If there's no performance fee for some reason, you know, they have a bad year. You know, you don't want the business to close because they've run out of money. So you need to have a base fee of money coming in just to pay the rent and keep the business open if they have a bad year. But still, I reckon 1.4% is a bit high. I'd like to see 1% and 20% performance fee. I agree that their benchmark is pretty easy, but still, the thing to look at is performance after fees, and I think in the case of L1 it's pretty good. Nate says, are you optimistic about Ardea? Is it better than LAC? I'm a grandpa loser in biotech and trying to figure a way out. Alternatively, is there a sector other than above that you are most optimistic about and or perhaps up and coming? And or perhaps an up and coming company? I don't know whether to be optimistic about Ardea or not. I'm optimistic about the sector. I mean, Ardea's business, as I recall, is nickel and cobalt, so they are absolutely focused on the battery market and supplying batteries. I think that in general, you know, that is a good business to be invested in. In general, the lithium battery market. So nickel and cobalt are two of the ingredients of that, along with lithium and graphite. So all of those products I think are worth buying. You might want to go back and have a look at. You might have looked at already my overview last Saturday when I had a long section on lithium. So the bear case and the bull case, in a way. I mean, I was talking about the Morgan Stanley forecast of a 25% fall in the lithium price. So they're quite bearish on most lithium stocks, Morgan Stanley. But I then had some counter arguments in there. So just have a look at last Saturday's overview to get some pros and cons about lithium. In general, I think that the battery market has got a long way to go. You might have seen, I think yesterday, the lithium stocks in Australia all popped between 5 and 10%, big gains yesterday. I don't think it was because of the Greens policy of encouraging electric vehicles in Australia and banning internal combustion ones by 2030, but maybe it had something to do with it. I mean, it's certainly the case that lots of countries are now announcing bans, proposed bans, on internal combustion engines just for emissions, not for carbon emissions, but you know, air pollution and health reasons. So look, I think that the demand for lithium batteries is going to go through the roof, to be honest, and I think it's going to be a good business to be in generally. I mean, it's going to have its ups and downs. There's a lot of supply coming onto the market, which is what Morgan Stanley's on about, you know, a lot of the market is controlled out of Chile, so you just need to be careful. But that's lithium. I mean, a good way to approach the whole topic is through something like Ardea, which has nickel and cobalt. But the thing is, you might want to spread your risk a bit. I mean, Ardea looks pretty good, but another one is Clean Tech. I think it's TCQ. Anyway, Clean Tech. It's they've got a nickel and cobalt mine in New South Wales, and there's some graphite businesses that I've been interviewing as well. You'll find on our website. I can't remember the names now, but so I think that it is a good sector to be invested in. If you're a grandpa loser in biotech. Nate, and I'm sorry to hear that. As for other up-and-coming companies, look, keep an eye on the interviews I'm doing. I mean, I try to only interview companies that are good. Occasionally, I come across a bit of a stinker, and I tell you that with the interview. Most of the companies I'm interviewing are good businesses. Who did I do this morning? I can't even remember now. My brains. Oh yeah, I interviewed. My next question's about Experience Co, which used to be Skydive the Beach, and Michael says I own shares in EXP. They've dropped since I purchased them. Thanks for your interview with the CEO today. I'm tossing up between holding or selling into any upswing. Bennelong are substantial shareholders, but a director has just sold some shares. What's your assessment of the business? Well, look, the founders are not selling. One of the directors did sell 350,000 shares, I noticed. Who knows? These people. The thing is, you don't know whether he's selling it because he's getting divorced or something. I think it is wrong to jump to conclusions just because the director's selling a few shares that the business is in trouble. I mean, the main thing that came out of that interview was that this is a business that's exposed to accidents. I mean, you know, if people die, which they did on this company's watch last year in October, you know, things get bad. So they've had a couple of bad accidents in the last sort of 6 months of people getting hurt or dying, and so I think that's the main risk with EXP. But what Anthony Ritter told me about was how they'd learnt from Ardent Leisure, you know, where the people died in the water ride at Dreamworld. And they handled that badly. It was a shocking disaster for the company as well as obviously for the families and people involved. But because they handled it so badly, the share price collapsed. The CEO got the arse. It was terrible. But I think Experience Co, Anthony Ritter, and the people there have handled that reasonably well. So look, and they are expanding, diversifying their revenue streams from other things. So look, bottom line is, I think it'd be a mistake to sell. If you like the company, you liked the company to begin with, stick with it. I reckon investing alongside Bennelong is a good idea. They are Australia's best fund manager. They've, on performance. As we've seen, they know what they're doing. They've got the best performance over the long term, 30% per annum, and I reckon you can do worse than sit alongside them. And it doesn't look like Bennelong's selling. They certainly wouldn't sell now, with the stock falling. They'd be buying, I'd say. Got some questions now about Labor's dividend tax plan, so we'll get into that. Madden, I think it's Madden, M-A-D-A-N, Madden, says, I've recently subscribed to TCI and I'm loving it, although I like the material presented, but the Money Cafe is my favourite. Thanks very much and welcome aboard, Madden. I have a question about the new policy being proposed by Labor regarding franking credits. I've just retired from the workforce, and if Labor wins the next election and implements its dreadful policy, it will certainly hit my pocket. I was wondering if every company gave unfranked dividends, say 100 cents per share instead of 70 cents per share franked dividend, then Bill Shorten won't get anything from us. What's your viewpoint about that? I don't think that if they didn't include the franking credits in their dividends, that would mean a higher dividend. I think that it basically would be the same amount, the dividend. I can check that out, but I'm pretty sure that the dividend wouldn't go up from 70 cents to 100 cents because the franking wasn't there. It might go up from 70 to 100 cents if they didn't pay any tax, obviously. If that's what you're talking about, Madden, then you'd be right, of course. The question is, how can they get out of paying tax? I mean, maybe they could shift their money offshore and do all those fancy things that other people do, Rupert Murdoch and co do, to get their tax down, so that they don't have any franking. That's possible, I guess. In that case, maybe the dividend would go up if they didn't pay any tax and the profit increased accordingly. Then the dividend would go up and there wouldn't be any franking. And maybe you're right. I mean, that would certainly solve the trouble. And maybe some companies will start to do that. They'll not worry about it. I mean, it's certainly the case that the franking system in Australia encourages companies to pay their full rate of tax because they become popular with investors like you looking for fully franked dividends. And so, you know, they might as well pay their tax, which they do. And so I think that there's an interesting case around that, which we should explore. As for anything else, there's some other questions on the same subject. Raina says, "Hi Alan, isn't it the case that a company pays tax in the name of shareholders for the profit which is then distributed to the shareholders as dividends? So the franking credit makes sure that people with incomes above the starting amount for taxes are not taxed twice. But the ones below the cutoff should get the franking back because they do not pay any tax on their dividends, equals profits on their shareholding. There are other countries as well which refund the already paid tax when people's income is not taxable." Yeah, look, I'm with you, Raina. I think you're right. The money, whether it's paid back or not paid to is kind of withheld in the sense that the taxpayer doesn't pay any tax on the dividend or receives some extra because the tax rate is below the rate at which they would they benefit. I think that you're right. They should get it back as cash. And so the principle, of course, is that the company is paying the tax. And the thing is that returns on debt, that is to say interest on debt, comes out of pre-tax profit, and the dividends are paid out of net profit after tax, and that's the difference. And so the interest is tax deductible, the dividends come out of after-tax profit and should not be taxable in the hands of those who receive them. Otherwise, they could pay the dividends out of pre-tax profit, and that'd be then tax deductible in the company's hands, and then in that case it could be taxable in the hands of shareholders. But since they're paid out of after-tax profits, then they've got to be not taxed in the hands of shareholders. Totally agree. Steve says, "Shorten's franking rebate change seems discriminatory. If you have to pay tax, you can have the credit. If you don't, you can't. Will that pass legal objections?" Well, interesting question, Steve, and whether people mount a legal challenge. It's possible, I guess. But I suppose the trouble is that the Parliament can legislate whatever it likes, and the law actually works off legislation. So presumably Bill Shorten will pass legislation that will... the only way it could be challenged is on constitutional grounds, and I can't see that it would be unconstitutional. Robert says, "Alan, what are your thoughts on the opposition leader Bill Shorten's wrecking ball policy of abolishing the imputation credits? Could this be the break that Malcolm Turnbull needs to turn the polls around, given that baby boomers and retirees are the biggest voting bloc? A lot of Australians enjoy their fully franked dividends." Well, I certainly think that Malcolm Turnbull's having a lovely time this week. He's been on the back foot for quite a while, and he's now joyfully kicking Turnbull's head in, or at least trying to, so kicking Shorten's head in over the franking change, because Shorten has just been sitting back watching the coalition implode lately with Barnaby Joyce and then Michaelia Cash and all that stuff been going on. It's just been fantastic for Shorten. And finally he stuck his head above the parapet, and I reckon he's made a mistake. And so Turnbull is, of course, going to make the most of this. Whether it turns it around for Turnbull, don't know. But it certainly, I think it's showing a bit of light at the end of Turnbull's tunnel, I think. Whether it means he wins, it might. I mean, I think it'll be very unpopular, because I think the main problem with it for Shorten is that the people who understand what he's done are losers, all of them, and the winners from his policy, that is to say, the people who aren't relying on franking, don't understand it, and so they're not going to actually. So it isn't going to actually make a lot of difference. People aren't going to vote for this because they don't get it. And the people who do get it are losers, and they will change their vote against Shorten as a result of it. You can only assume that what he's got in mind here is that the money is going to be used to buy votes closer to the election once the dust is settled. And we'll have to see what he does with that. If he proposes to simply put it in the bank and increase the reduce the budget's deficit, then I reckon it could be a big loser for him. David says, do you think you'll be able to use franking credits owned by your SMSF to offset tax obligations in a personal share account? I've got no idea, David, sorry. I'll have to get back to you on that. Don't know. Michael says, hi Alan, can we chat about the elephant in the room? Yep, Bill's new policy. Yep, I've just been doing that, so I hope we've satisfied that. Michael, James says, what do you think of latest? Yep, so that's it on the specific questions about that. If you want to put in more questions into Facebook, I'll get to them over the next few days. On this, obviously I'll be writing about it in the overview on Saturday at some length, I think, and we'll see how that goes. Now, on to other topics. Yes, there are still plenty of questions, interesting topics to come, so don't go away, stick around. Sasha says, the LBT Innovations share price has been declining rapidly. Last week, the company announced a $7 million private placement at 15 cents per share, followed by a share purchase plan for existing shareholders. Now, this was a 25% discount to the price before the announcement. Normally, that would sound like a good deal. However, the shares have dropped even lower to 14 cents. Do you have any insights into what's going on at this company? Is the latest drop due to dilution from the new shares being issued? It was certainly a coincidence, Sasha. The shares were going along fine, and then they announced a 15 cent per share placement at $7 million, and the price collapsed. So it started off being a 25% discount to the share price, and then it wasn't. Suddenly, it was 15 cents is at a small premium, and I can't find anything else. I haven't had a chance to ring the company up to see what's going on. Or ring anyone else up. I have looked at the announcements. There's been no other announcement apart from the placement. So there's no other reason that I can see for the share price falling apart from the dilution that you talk about, Sasha. So I can only assume that's it. And maybe the market and shareholders and investors have got the willies because the company suddenly thinks it can only raise cash at 15 cents. And it got screwed by the people supplying the capital. And you must wonder then, and the market is clearly wondering, what do they know that I don't know? The people who are putting the $7 million in. I mean, why would they only be putting the money in at 15 cents a share? So look, I did interview them a while ago. I can't remember exactly when, but I think it might have been about a year ago. It looked like a good company to me, using artificial intelligence to do blood testing for pathologies. It looked like a terrific idea. They were basically replacing human beings in pathologies where the human beings were looking through microscopes at blood smears, doing blood tests, where artificial intelligence could do it better. So whether that business turns out not to be a good idea at all and pathologists don't want to do it, I don't know. So I'll put them on the list to interview them again shortly, and we'll see if we can find out what's going on. Roz says, Alan and group, what do you think of things like BrickX and Acorns? I think it's only ETFs. Well, Acorns certainly is only ETFs. Look, it's a pretty small thing. Basically what they do is they collect, my son does this, I mean I don't do it, but my son uses Acorns, and it basically rounds up odd amounts and invests the money in ETFs. So he's got a few $100s out of this over a 12-month or 2-year period. It's not bad, you're not going to get rich out of it, but it's, it's collecting a bit of money that you would have otherwise wasted. So nothing wrong with acorns at all, but don't expect to get rich out of it. It's just a sort of a way of collecting spare bits of change. BrickX is a totally different thing. It's a fractional property investing vehicle, allows you to invest as little as $100 in a residential property by buying a brick. And I've got a slight conflict of interest here in that I'm a significant shareholder in another business called Domicom, which does much the same thing, although it's not the same setup. Obviously, it's a different way of doing it, but basically it's fractional property investing. I think the whole thing is a good idea, but the thing is Domicom's been an absolute disaster. It IPO'd at 50 cents, about a year ago, maybe 18 months ago. It is now under 10 cents. So I'm okay because I got in quite early, and but I haven't made any money on it. I think my average price is about 10 cents, and that's what the share price is now. So I haven't made any money out of it. I keep talking to them and wondering what's going on and when are they going to start doing any good. Whether it's because fractional property investing isn't taking off. I suppose that's the problem. People either buy a property or they don't. And I guess part of the problem is that you're able to invest in a residential property, or at least you have been, without much money at all. You certainly haven't had to have 20% deposit. You can do it with 5% deposit. And I think a lot of people have been buying investment properties with no deposit at all. And so you're effectively buying an entire property with $100 because the bank will lend you the money. So I think that might have caused the business of fractional property investing to go off. And the other problem with things like that is that it turns out that this is not a great time to be investing in residential property, I think, except if you're in Hobart. Sydney's prices are falling, Melbourne's are peaking, probably going to fall for a while. I mean, look, I think the whole market, the property market, will be underpinned by immigration. There's no sign of that coming down. I think the demand will be there. I think the property market is having a soft landing, not going to be a crash, but I don't think the returns are going to be great over the next few years. Capital gains will be minimal, if there'll be any at all, and the yields are whatever they are, 3%, maybe 4% if you're lucky. So I think that the principle of fractional property investing is good, which is why I invested in Domicom. But as I say, it hasn't been a great thing for me. And as for whether BrickX is a good idea, I don't know. I think I've looked at the platform. It looks okay. It looks a bit simpler than Domicom, to be honest. So maybe it's fine. Duncan says, best wishes to Alan and Deb. Deb being my wife, and thank you for that, Duncan. I hope this week is a better week for you both. Well, it is. I'm pleased to say thank you. My question, who thinks this is the blow-off rally to end our current late-stage bull market? Maybe in retrospect, we won't see the 20% to 50% gains of previous blow-off rallies, but we'll see that the irrational exuberance was in fact the markets ignoring all of the risky news like trade wars, etc. Yes, well, so far the market is ignoring the trade war news. Whether it continues to ignore it as things heat up, because it does look like Trump is going to announce more tariffs against China for IP theft, which I kind of foreshadowed last week. So look, as to whether it's a blow-off rally, look, I've said a few times, I think the risk, and that's what we're talking about, risk and possibility, rather than any certainties. The risk is to the upside rather than the downside. I think that in a situation like this where you've got the global economy is going well, synchronised expansion everywhere, America, Japan, China, Europe, Australia, all growing, not booming, but all growing at the same time. Interest rates still very low, rising in America, but still very low and not rising anywhere else. So it's a good time for share investing, and you would say that the risk is to the upside, not the downside, on account of you only really get bear markets in recessions. You get big corrections. You can get big corrections without a recession, as we saw in October 1987. But it didn't take long for the market to recover back to the September 87 peak. And that's because there was no recession at that point. I mean, obviously there was a recession later. So if there's no recession, markets do tend to have blow-off rallies. Now, I think you're right, Duncan, to raise the point about the trade war, because the one thing that could bring about a recession is a really significant bout of global protectionism. So, I'm quite concerned about this. I think it could get pretty nasty. So, I certainly wouldn't be betting on a blow-off rally now. I think it's really a time to make sure you've got quality in your portfolio. It's really all about, don't have stocks that you hope are going to go up because they've been going up. I don't mean to switch from sort of growth investing to value investing to sort of just hunker down entirely, but it is a time to have good quality companies that are going to survive in the long term, and in particular are globally focused. I think that it's time to look to the quality of your portfolio. Don't try to play the market. Make sure you've got good companies in your portfolio. That's the only way to handle this, I think. And certainly don't sit there sort of buying the market in the expectation that you're going to get a 20 to 50% gain out of a blow-off rally, because apart from anything else, it's very difficult to pick the top, if not impossible. So that's it. No more questions. As always, keep it going in Facebook, and I'll see you there during the week. I've been a bit lax on Facebook lately, I know, because of what's been going on at home, but I'll get back into it. Remember, this live stream today and my answers are general advice. It may not be appropriate for you, so just remember that. Today's CEO interview is Simon Mutter, the CEO of Spark New Zealand. Now, it's a bit confusing because Spark in Australia is an electricity company, Spark Infrastructure. In New Zealand, Spark is the old telecom, their version of Telstra. And they had a splitting up of their telecom business over there, so that the infrastructure was moved into the business called Chorus, and telecom was left as a reseller of the infrastructure and a mobile business, just a bit like Telstra is becoming in Australia, and that's called Spark New Zealand. Interesting business, good yield stock. What's its yield? Just let me have a look while I'm talking to you. SPK is the 6.2% yield. But of course, because it's a New Zealand company, it's not franked. So no franking, because the money, it's all New Zealand tax that they're paying, not Australian tax. But that's okay now with Bill Shorten in charge. And anyway, 6.2% unfranked is not too shabby. It's all right. I think they're probably going to get some growth happening. That's what they think anyway. Worth listening to the interviews, all I can say. Check it out. Simon Mutter of Spark New Zealand. Percy Allen's monthly column on market timing is out today. And of course, don't forget about his book. He's got a book which really explains all the market timing stuff. It's called Crash Proof. We're selling it for a special discount price to members of $10 per ebook. So you can go onto our website and get hold of that if you'd like. And I think it's well worth doing. Percy's a smart guy. He's been looking at market timing for a while, and if you're interested in how the market timing works, how best to insulate your portfolio against a crash, you should read Percy's book. And I'm off to the cafe in a minute to talk to Kirby. And naturally, we're going to be talking about Bill Shorten's policy as well as trade wars and a few other things. So check that out when it goes up on the site later on. And finally, Crypto 101. Now, Greg Demopoulos, our producer here, has spent the last couple of days at a big blockchain and cryptocurrency conference in Melbourne, and he's put together a package of stuff on that, which is quite interesting and well worth checking out. So thanks for your company. There's always plenty of stuff on our on the Constant Investor, so plenty of stuff to read and listen to, and we'll see you next week. Thank you.